Most people overpay their taxes by thousands of dollars every single year, and it is almost never because they cheated or made a mistake. It is because nobody ever told them these 8 deductions exist. By the end of this video, you will know all 8, including one that lets you collect rent from your own business completely tax-free. Quick note before we start. I am not your accountant, and this is general education, not tax advice. Rules change, dollar amounts get adjusted every year, and your situation is yours alone. Take these to a licensed tax professional and confirm the current numbers before you act on any of them. Let us start with the one almost everybody qualifies for, and almost nobody claims correctly. The first is the home office deduction. There is a myth floating around that claiming a home office triggers an audit. That myth has cost taxpayers a fortune. The deduction is completely legitimate if you are self-employed, run a side business, or freelance, and you use part of your home regularly and exclusively for that work. The word exclusively is what trips people up. Your kitchen table does not count if your family eats dinner there. A spare bedroom you converted into an office does. There are 2 ways to calculate it. The simplified method gives you a flat rate per square foot of dedicated office space, capped at 300 square feet, which lands you around $1,500 with almost no paperwork. The regular method is more work, but usually pays more. You calculate what percentage of your home the office takes up, then deduct that same percentage of your rent or mortgage interest, your utilities, your internet, your renters or homeowners insurance, and your repairs. If your office is 12% of your home, you deduct 12% of all of it. For most people running a real home-based business, the regular method beats the simplified method by a wide margin. Run both. Take the bigger one. The second is vehicle mileage, and this is where the numbers get genuinely surprising. If you drive for business, you can deduct a set rate for every business mile you put on your car. That rate has been running around 70 cents per mile, and the IRS updates it annually, so check the current figure. Here is what people miss. 20,000 business miles at that rate is roughly $14,000 off your taxable income. Not a $14,000 refund, but $14,000 that never gets taxed in the first place. The catch is documentation. You need a log with the date, the destination, the purpose, and the miles. Reconstruct it from memory in April, and you will lose the deduction in an audit. Use a mileage tracking app that runs in the background, and it takes 0 effort. And remember, your commute from home to a regular workplace does not count. But if your home is your principal place of business, trips from there to clients, suppliers, and job sites do. Third, self-employed health insurance premiums. If you are self-employed and not eligible for a plan through an employer or a spouse's employer, you can deduct what you pay in health, dental, and qualifying long-term care premiums for yourself, your spouse, and your dependents. What makes this one powerful is that it is an above-the-line deduction. That means you do not have to itemize to get it, and it reduces your adjusted gross income directly, which then affects other thresholds and credits downstream. For a family paying market rate premiums, this alone can be worth well over $10,000 in deductions. Fourth, and this one has a strict deadline attached, is startup costs. When you launch a business, you can typically deduct up to $5,000 of startup expenses and another $5,000 of organizational costs in your very first year, with the remainder amortized over time. Startup costs include market research, travel to scout locations, professional fees, advertising you ran before opening, and training. The reason people miss this is timing. They spent the money before the business technically existed and assume it does not count. It does, as long as it was in preparation for the business you actually launched. Fifth is retirement contributions, and for the self-employed, this is the single biggest legal deduction available to most people. A traditional IRA caps out at a few $1,000s. A solo 401k or a SEP IRA operates on an entirely different scale. Through a solo 401k, you can contribute as the employee and again as the employer, and combined contribution limits run into the tens of thousands of dollars per year, with an additional catch-up amount if you are over 50. That money goes into your own retirement account. It is still yours, and it comes off your taxable income right now. You are not spending it. You are relocating it. That is the part people fail to appreciate. Every other deduction on this list requires you to spend money to save money. This one requires you to save money to save money. Number 6 is the qualified business income deduction, and if you have a pass-through business and are not claiming this, pause the video and go check your last return. Pass-through entities include sole proprietorships, partnerships, S corporations, and most LLCs. Under this provision, you may be able to deduct up to 20% of your qualified business income before you calculate what you owe. 20%. If your business nets $100,000, you may only be taxed on $80,000 of it. There are income phase-outs and additional limits for specified service businesses, and the rules around this provision have been a moving target legislatively. So this is the one above all others where you want a professional confirming your eligibility for the current tax year. But the sheer size of it is why it belongs on this list. 7th is equipment depreciation, specifically the accelerated kind. Normally, when you buy a business asset, you deduct its cost slowly over its useful life. Section 179 and bonus depreciation let you deduct a large portion or all of it in the year you put it into service instead. Computers, cameras, machinery, office furniture, software, and qualifying vehicles can all fall under this. A photographer buying a $12,000 camera kit does not have to spread that over 5 years. A contractor buying equipment can often write the whole thing off the year they start using it. The limits are generous and they change, but the strategic point is timing. If you are having a high-income year, moving a planned equipment purchase from January into December can shift a meaningful deduction into the year you actually need it. And now the last one, which is the one most people have genuinely never heard of. It is called the Augusta Rule, named after Augusta, Georgia, where homeowners rented out their houses during the Masters Golf Tournament. Under this provision, you can rent out your personal residence for up to 14 days per year, and the rental income is completely tax-free. You do not report it at all. Here is where it gets interesting for business owners. If you own a business, your business can rent your home from you for legitimate business purposes. Board meetings, strategy sessions, team planning days, client events. The business deducts the rent as a business expense, and you personally receive that money tax-free, up to 14 days a year. If a comparable meeting space in your area rents for $1,000 a day, 14 days is $14,000 deducted by the business and received by you without tax. The requirements are not optional, though. The rent must be a reasonable market rate, so get written quotes from actual venues nearby. The meetings must be real and documented with agendas, attendees, and minutes. There should be a written rental agreement between you and your business, and it does not work for a sole proprietor filing on a Schedule C because you cannot rent property to yourself. You need a separate entity, such as an S corporation or a partnership. Done sloppily, this gets disallowed. Done properly, it is one of the cleanest strategies in the code. So that is 8. Home office, vehicle mileage.